Craig, thank you so much for joining us today.
Hey, Elijah, nice to see you again, my friend.
All right. Now, the first topic I'd like to discuss is kind of the political situation right now in the United States because, midterms are coming up and a lot of interesting things are happening right now, and kind of a lot of things could happen also if the Democrats take over the House. Can you kind of run us through or take us on a journey through the political situation right now?
Well, sure. I mean, I'm no political scientist, and so I'm not going to try to speculate as to what the election results will entail by the time we get to early November. But I think people need to be forward thinking and consider the risks, if you will, to this mantra that has been shoved down our throats and has played out actually ever since election night back in 2016. Because if you recall, Elijah, in the days and weeks leading up to that election, we're all told that, if Trump wins, oh God, all hell's going to break loose and the stock market's going to crash and all this other stuff. And as Trump won on election night, that's exactly what happened. And I think most of us went to bed that night with the stock futures down 600 points and that kind of thing. You woke up the next morning and everything was magically fine. And we were told beginning that very next day that this was because, Trump was going to make the dollar go up and he was going to make interest rates go up and the economy was going to soar. And so therefore all these, there was a reason why the stock market turned. And that kind of is what's played out in the almost 2 years since, right? And it has kind of played out. The stock market has continued to rally. We haven't burst the bond market bubble yet, and that's probably more due to, how much QE has been done in the last 10 years. And a lot of folks were talking about king dollar and how the dollar was going to soar and all that kind of stuff. And we've had a little rally over the last few months, but we're still well below. I think we're about 101, 102, maybe even 103 on the dollar index in January of 2017, and we're now 95. Okay, so the dollar hasn't really soared. But anyway, put all that back together. All of this stuff has been predicated upon this Trump and his policies and how they'd be impacted, how they would impact confidence of businesses and consumers and all that here in the U.S. Okay, so fast forward to this next upcoming election. If you don't live in the U.S., we do this every 2 years, and every race, every seat in the U.S. House of Representatives is up for election every 2 years. Currently, the U.S. House of Representatives is controlled by the Republicans, as is the Senate. Now, I don't know if there's a lot of threat that the Democrats will take the Senate, but there is this phenomenon that seems to occur every first midterm election of a new president where his party loses seats. I mean, you can go back and look back through, history and see this phenomenon play out. Okay, well, if Trump loses the House, what's that going to mean? It's going to mean about, 800 different investigations are going to get started by the House Democrats, and this Trump agenda, whatever it is going to grind to a screeching halt, and it will invariably impact business confidence, consumer confidence, and then this whole mantra that I just laid out over the last couple of minutes is going to start to reverse itself, and it will probably lead to dollar weakness. And if the dollar gets weak, then that's going to affect, all these tariffs and trade plans that Trump has, and it's also going to impact, at the end of the day, gold and silver. Because a large part of why gold and silver have been falling for the last several months is that the dollar's been rallying. And if it turns and reverses the last couple months of this year, then we'll probably get a rally in the metals too. So this is something everybody has to be looking at from anywhere in the world.
Definitely. And mentioning the metals, we haven't been doing that great in the precious metal markets over the past few months. Why do you think that is?
Well, first and foremost, Elijah, it's the dollar. That's probably the biggest driving thing. The commodity sector as a whole was really doing well in the first 3 or 4 months of the year. A lot of commodity indices were breaking out. Gold was at multiple year highs. Silver was doing okay. And then the dollar rallied about 6 or 7% from middle of April to the 1st of June. And that really took the starch out of commodities, and it started driving gold and silver. I think what's interesting to note at this particular time, though, Elijah, and I'm going to be kind of contrary to maybe what other precious metals analysts want to say on this subject, but we've noted that the change in the internal dynamics of the Commitment of Traders report. And that CFTC report has been a pretty reliable indicator, at least if anything, of impending price smashes for the last 10 or 12 years, where speculators would get net long hundreds of thousands of COMEX gold and silver contracts, and that would put the banks or the commercials net short. And invariably, the banks would win, price would smash, the commercials or the speculators would run for cover, start dumping their longs, and a whole cycle would begin again. Well, at this point in time, we're noticing record extremes of speculators being short. And that's leading a lot of folks to conclude, well, now the opposite's going to happen. There's going to be all this short covering and prices are going to spike. I've decided I don't look at it that way. What I mentioned earlier, when we got to these upward extremes and then price was smashed, it was because there were extremes. The speculators were long 300,000 gold contracts and the banks were short 300,000. But at present, it's not an extreme. The speculators are short, but they're only short something like 15,000. And the banks on the last report were net long 13 contracts. So it would seem as if maybe a new equilibrium has been reached rather than some massive bullish signal. So I'm going to revert back to some of the stuff we talked about earlier. I'm going to watch political risk, maybe even geopolitical risk, and let's just see how that impacts the dollar, see how that impacts Trump's policies vis-a-vis, that makes me sound smart when I say vis-a-vis China. Maybe these tariffs and trade notions will go by the wayside. Maybe that'll cause the yuan to strengthen back up, and maybe that'll help gold start to rally back. That's kind of the direction I'm looking.
Now, kind of turning course here, 10 years ago, this last Friday, the Lehman Brothers Bank collapsed. Now, This was, this kind of precipitated the 2008 crisis, the Great Recession, the worst crisis we've seen since the Great Depression. So could this happen again? And are the safeguards in place for, could this happen again? And are the safeguards there so that if it happened, it wouldn't be that bad?
Can this happen again? Of course it can happen again. Maybe not the same way. With this toxic, mortgage-backed securities and collateralized debt obligations and all the other crap that Wall Street dreamed up in the mid-2000s that led to that crisis. But it's just, the same conditions are there. They're just there in other markets. Again, you can look at real estate again. You can look at the massive exposure now of pension funds and the like to low interest rates. Because if interest rates were to skyrocket, bond prices would fall, which would make pension funds, government and private, even more undercapitalized. Things like that can lead to a contagion. Italian banks could begin to melt down. And all of the banks in Europe are all tied together in a daisy chain of risk where they own each other's bonds. And so if one goes belly up, then it drags down others. Sovereign nations besides Italy could do the same thing. So there's a lot of risk out there that is still present that will bring about the next crisis. Okay, the great financial crisis wasn't the first one, and it won't be the last one. And at the end of the day, that still augurs that you continually hold some gold, especially in physical form where you actually can lay your hands on it, and you own some silver too, and you just try to stay situationally aware of the risks to your financial health that are still out there and growing by the day.
So what do you say to those people that say, after the 2008 crash, there were a lot of safeguards put in place to prevent another crisis like this?
Like the Dodd-Frank bill or something?
Yeah.
Yeah. What did that do? You could trace the origins of that 2008 crisis back to the mid-90s when the Glass-Steagall Act was torn apart and shredded, and commercial banks were allowed to get into investment banking. Hey, you put Glass-Steagall back in? Okay, then maybe I'll believe that actual concrete steps are being taken. But you try bringing that up, just do some research about the few people that have tried to bring that up in Congress, and the wall of lobbyist money that met it and everything just died. So let's put all that back together, Elijah. And I would just say, until the banks get out of this business of leverage and trading and proprietary trading and investment banking and just get back to their original, or put it this way, allow the banks that no longer operate just as banks to lose their FDIC, and too big to fail protection, that might do it too. It will be a market way of enforcing more prudent tactics and some sanity on them. But in the meantime, hey, I don't think the structure that got us into this place, the structures that were put in place once Glass-Steagall was repealed, I don't think anything's been done to address that. And so therefore, I think the rest is just window dressing.
All right. Well, Craig HEMKE, thank you so much for joining us today. Before we let you go, did you want to share with the viewers any last thoughts you had, and where they can find you online?
Yeah. Well, let's start there. TF Metals Report is an online community of, we'll call it like-minded folks that are all here. I mean, we recognize the situation the world remains in, and we're all here to help each other through it. I mean, I do some analysis and talk about prices and where I think they're headed, but I think most people would concede that the real value of my site is the people that populate it and willfully share information together. So thank you for allowing me to put that plug in. I just would, at this point, I would avoid I guess my final bit of advice, whatever you want to call it, would be to avoid the extreme bullishness that's out there based solely upon things like the Commitment of Traders report. And I would instead focus heavily upon political risk to the U.S. dollar over the remaining 3 or 4 months of this year. Because if the Democrats take control of the House, which is where we began this discussion, Trump's agenda, whatever that is going to grind to a halt. The nonstop investigations are going to destroy consumer and business confidence. That's going to cause the dollar to fall. And that's going to cause gold and silver to begin rallying back. And maybe we will squeeze some of those shorts. But in the meantime, again, I just would caution people getting too excited about any one particular seemingly bullish fundamental. And let's wait till we actually see some real turn before we start aggressively taking any action, to buy more metal, that kind of stuff.
All right. Sounds good. Craig HEMKE, once again, thank you so much for your time.